Corporate Finance OneNote practice problem. In this presentation, we're going to work a practice problem in OneNote related to sales projection with multiple scenarios. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 414 Sales Projection Multiple Scenarios tab under the Practice Problems section. Closing this back out, we're going to have our information up top. We will use that then to populate the blue area, doing our calculations down here in the blue area of our worksheet. So what we have are expected sales of units under three different scenarios. So when we're thinking about projections and budgets into the future, we typically have to do them in a systematic way, meaning we have to start typically with the sales type of activity that's going to happen. How many units are we going to sell? What's going to be our sales numbers? Now, there's going to be some predictions on some projections that might be needed in order to make that kind of decision-making process. This is one method that we can use in order to do so, in order to project into the future when we have different scenarios that could be at play. So what is the expected value of the total sales projection? So we're imagining we have these three different scenarios in which we have A, B, and C. If A happens, we're projecting out that we would have 310 units at a sales price of $37. If B happens, we're having a 555 units at $50. If C happens, we have the 865 units at $65. Now, if we're thinking about these three items that could happen in the future, and we're trying to figure out, okay, what's going to be our total sales number that we can use for our projection purposes to think out into the future of what may happen, one way we can think about doing that is instead of picking simply one scenario, we can say, well, what is the probability of each of these scenarios happening? What's the likelihood of them happening? Now, this is a projection type of process, so we would have to come up with that number somehow. We just have to say, well, I think A is going to be 20% likely, B 50% likely, and C 30% likely, or something in that nature, some likelihood that would add up to 100%. And in so doing, we can then kind of figure out an estimate, basically kind of like an average based on the three scenarios that could be happening. So, for example, if we took a look at scenario A and we took the 310 units sold times the price of $37, if that happened, we would have 11,470. If scenario B happened, we'd have 555 times the $50, which would be the 27,750. And if scenario C happened, we would have the 865 units times the $65, which would be the 56,225. So then we're going to consider, well, which of those scenarios, is actually going to happen? We can take some type of estimate. So now we're going to say, well, we think the likelihood is 20, 50, 30 for a total percent likelihood of 100% of these items. And in so doing, we can then get our expected value. We could say, okay, let's take the total value we had, 11,470, multiply it times that 20% or 0.2, and that'll give us our 2,294. If we did this here, we would take the 27,750 for B times the likelihood of 50% or 0.5, giving us that 13,875. And then, of course, finally for C, we would have the 56,225 times the probability of 0.3, or the likelihood, our expected probability, that's going to be the 16,868. And if we were to add them up, then we're going to take the 2294 plus 13875 plus 1687868 about to give us the 3337, and that's going to be a way to kind of average rather than taking one of these component numbers. So we basically kind of average these. We didn't completely an even average would have been something like this, right? 11470 plus 27750 plus the 56225, and then divided by 3 would be the average. But we took a weighted average based on what we think the likely probability would be, which means we weighed out the probabilities a bit differently according to what we think is most likely to happen. That's one way we can do kind of our estimates. So when we're thinking into the future, when we're thinking about projections and estimates, we might have to do some procedures such as this to try to get some idea, some benchmark as to what's going to happen. And then we can move forward with the projections from there. A projection analysis tool such as this is one useful tool in order to do so. Let's scroll on down and take a look at another scenario. So we have the expected sales of units under 3 scenarios. So now we have the 3 scenarios, and let's just do the calculation another time with some different numbers here. So we got A, B, and C. Now we've got the units and the price for scenario A that could happen, scenario B, units in price, scenario C that could happen. And we're going to then look at the probability of those 3 things happening in an attempt to come up with an estimated sales number in a way that could be useful for us to make a projection into the future, that being the probability of 40, 40, 20. How would we come up to that probability? We would have to, it's our best guess. This is all of our best guess, but we need to make a guess so that we can start to plan on something. We have to have a goal. We have to have a target. So how are we going to put together that target? We got to in some way come up with a projection into the future. This is one way that we can do so. So if we look at scenario A in and of itself, we would take the 420 units times the $18 to get the 7,560. Scenario B being the 729 times the price of the 27 per unit, giving us the 19,683. And finally, scenario C, the one that we would like to see, being the 1,101 units at the $29, giving us the 31,929. Now, if we break out the likelihood of 40, 40, 20 in these scenarios, we can get a kind of average that could take place here. We could say, well, then let's say like if the first scenario is 40% likely, we could take then the result, the 7,560 times 0.4, and that would be the 3,024. And then we could take scenario B, the result of 19,683 times 0.4 to get the about 7873. About, it should round down. I did this in Excel, so you might have a little bit of rounding error, but it's an estimate. So rounding happens in an estimate. It's not perfect here. So then we have the 31,929. I mean, obviously in a book problem, remember you're going to have to make it round to whatever number that they're rounding to oftentimes. But again, in practice, you're looking to make it something that's useful for decision-making purposes. And always rounding's always a factor. So then we're going to take the 31,929 times the 0.2, that giving us the 6,386 about. If we were to add these up, we're going to take the 3,024 plus the 7,873 plus the 6,386. That's going to give us our 17,283. So it's a kind of an average type of format, but it's more of a weighted type of average because we're putting a different weight based on our knowledge of what we think the likelihood of the outcome would be. In other words, if you just took a straight average, you could take these 3 results and say, well, 7,560 plus 19,683 plus 3,1929 divided by 3 would give us the 19,724. That might be useful, and you can use that. That's another method that could be used, but you might weight it differently based on your understanding, and basically use this kind of method to use some projections into the future.